Hello and welcome to the weekly special episode of the Daily Brief, which we call as the Weekly Brief. Here we collect and bring together all the best stories that we've covered through the entire week. So let's begin. Let's talk about how Ultratech Cement and India Cement are merging into one entity. Ultratech Cement, which is India's largest cement maker and the world's third largest if you exclude China, is buying a controlling stake in India Cements, which is a major player in South India. Here is what is happening in simple words. See, Ultratech is buying about 32% stake in India Cements from the promoters for over 3,900 crore rupees. They had already bought a 23% stake back in June, but after this deal, they will now own about 55% of India Cements as a company. This acquisition is a big deal because it will make Ultratech Cement a dominant player in the fragmented South Indian market. It will increase its market share from 12% to a 23% in this region. Now, this is not something new. The Indian cement industry has been consolidating for over a decade now. In the last 10 years or so, we've seen some high-profile deals happening here. First is Nirmal Limited acquiring Lafarge India for 9,400 crores. Second was when Ambani bought Ambuja Cement for over 80,000 crore rupees. Now, this latest move puts the Birlas, who own Ultratech, in direct competition with the Adanis, who own Ambuja Cement, ACC, and a few others. Adani, for your context, is currently the second largest player in the cement market of India. But why is Ultratech making this move, you might be wondering? Well, a few reasons. First, India is still developing as a nation. We need massive investments in infrastructure, roads, bridges, houses, industries, etc., and they all need cement. Second, the infrastructure push is one of the big reasons why India has been one of the fastest growing economies in the world right now. In fact, India's GDP growth over the last 4 to 5 years has primarily been driven by government investments. Third, the recent budget plans to invest 10 lakh crore rupees to provide housing for 1 crore urban poor and middle class families under the PM Awas Yojana Urban 2.0. The cement industry is highly competitive and fragmented with many smaller firms. By consolidating these smaller firms, Ultratech can improve its operational efficiency and become an even bigger player in this industry. Now, moving on to the next story of the day, SBI Card, which is India's second largest credit card issuer after HDFC Bank, recently announced their results. And their results were very disappointing to say the least, but they still had several interesting trends. Their profits are flat, there is no growth quarter on quarter or year on year. They have also been steadily losing market share over the last couple of years or so. Second, corporate spends have taken a hit thanks to RBI's regulatory crackdown. They have banned certain types of credit card spends in the B2B space. On the flip side, retail spends are growing at a healthy pace. Third, non-performing assets or NPAs are on the rise for SBI cards. Both stage 2 and stage 3 loans are increasing. I'll break that down for you if you don't know. Stage 1 loans are overdue by up to 30 days. Stage 2 loans are overdue by 31 to 89 days. Stage 3 loans are overdue by more than 90 days. This means that people aren't just missing their credit card payments, many seem to have also borrowed much more than what they can handle or pay back. SBI Cards is taking action though. They have reduced limits on 5 lakh credit cards this quarter after cutting limits on 15 lakh cards in the previous quarter. But here's the thing. This rising bad loan trend is just not an SBI Cards problem. It is happening across the industry, especially in the unsecured retail lending segment. I'll throw some more interesting tidbits for you from a Kotak research report that came out recently. Out of all the money people owe SBI Cards, 62% is earning interest. That is good news for SBI Cards because they are making money off those outstanding balances. Second, the share of new accounts from salaried individuals dropped from 79% in 2021 to 68%. Meanwhile, the share of self-employed individuals has gone up from 21% to 32%. The share of cards in tier 3 cities has exploded as well. It was around 10% at the end of 2021 and now it is at about 30%, which is crazy. We look at how SEBI is worried about the increasing number of people trading in F&O who are losing money. See, in the last fiscal year, 92.5 lakh unique investors traded in index derivatives and 85% of them incurred net trading losses. Now that number is huge. So SEBI recently formed a committee to get recommendations on how to reduce speculations in the market. The committee then made its recommendations, based on which SEBI published a consultation paper yesterday. I'll briefly talk you through what SEBI is proposing in very quick pointers. See, right now 6 weekly options contracts are available on multiple indices like Bank Nifty, which expires on Wednesday, Nifty, which expires on Thursday, and Sensex, which expires on Friday. But SEBI is now proposing to restrict weekly option contracts to major benchmark indexes. So for example, it could only be the Nifty and Sensex options which expire weekly and the rest of the contracts would expire monthly only. The next is that the calendar spread benefit might go away on the expiry day. See, I'll explain this. When you hold two options on the same index but with different expiry dates, you usually get a margin benefit. This basically is called a calendar spread. The next proposal is that on expiry day, the margin required will go up by 1 to 3% of the contract value. The last time SEBI had reviewed the contract sizes was back in 2015, and since then the markets have grown exponentially, so it is now proposing to increase them again by about 3 times. Currently, the value of an index derivatives contract is between 5 to 10 lakhs, but it might be increased in a phased manner from 15 to 20 lakhs and then from 20 to 30 lakhs after 6 months. Moving on to the next story, let's talk about how telecom wars are maybe slowly drying down now. See, before 2010, telecom was one of the hottest sectors. Everybody, including the biggest industrialists in India, wanted a piece of the action. But then people slowly started to realize that telecom is a capital hungry industry, and over the next decade or so, the number of casualties in this industry increased by quite a lot. The likes of Uninor, Tata Docomo, Arcom, and Aircel all either got acquired or just shut down. Today, the telecom industry is only dominated by players like Bharti Airtel and Reliance Jio. A couple of other players like Vodafone Idea, BSNL, and MTNL also exist, but they're really struggling with all sorts of problems. Interestingly, telecom stocks were among the worst performing investments over the last decade or so, but now things slowly seem to be changing. The last big event in this sector was Reliance Jio's entry with its free plans. Now, thanks to its pricing, Jio very quickly gained market share at the expense of companies like Vodafone and BSNL. Today, Jio is the only dominant player remaining apart from Airtel. By the way, here's a fun question for you. Can you guess who was the market leader of telecom back in 2018? Let me answer. Believe it or not, it was Vodafone. Vodafone had a market share of close to 35 to 40% of mobile subscribers back then. Now, because of Jio and Airtel's rise, it has now fallen down to less than 20%. Vodafone Idea could basically never get its act right. Given the massive investments required in spectrum and the pricing wars due to Jio, they accumulated massive amounts of debt and they never stood a chance against Airtel and Jio. They basically had to be saved by a bailout by the government of India. And now they're in such bad shape that they are paying dues to their suppliers by giving shares instead of money. S&P recently published a report on the sector which had some very interesting insights that you might want to know. According to the report, since Jio and Airtel are the only remaining players, this means that they can now focus on just improving their financials instead of engaging in price wars like they had to do earlier. Now, given that the telecom sector is very capital heavy and both these companies have already invested heavily to roll out 4G and 5G services, any increase in tariffs will now directly go to the bottom line to improve their profitability. Recently, Jio took the first step and announced an increase in tariff prices. They were soon followed by Airtel and Vodafone Idea as well. All of them raised prices by about 10 to 25%, and this was the first significant across the board price hike ever since November 2021. Now, all of these companies' focus seems to be on generating more revenue per user. Sunil Bharti Mittal, who's the chairperson of Airtel, said in an interview with ET, and I quote, "We have spent nearly 80,000 crore rupees on 5G spectrum and rollout. Our competitors have spent more than 100,000 crore rupees and there are no additional revenues, as you know. So the time has come now to start rationalize and repair tariffs." He further said, and I quote, "I think we are heading towards an ARPU of 300 rupees and I hope it happens within the coming financial year, which we are entering from April 1st. We need more investments into fibers, infrastructure, and rural areas." Now, although price hikes can lead to some customers dropping their plans or switching to cheaper options, data consumption habits usually tend to be very sticky. In simpler words, once a customer is used to a certain data usage level, they are likely to continue using similar amounts of data even if the prices go up. I'll put it in numbers to explain this simply. During the March quarter, people used over 5,000 crore GBs worth of mobile data. This is almost double the amount of mobile data that they used 3 years ago. One interesting insight about the telecom sector is that every 10 rupees increase in ARPU or average revenue per user will translate into an annual EBITDA boost of 2500 crore rupees and more for Bharti Airtel and 3000 crore rupees and more for Reliance Jio. The telecom companies expect the ARPU or average revenue per user to continue rising as they implement more rounds of tariff hikes. These higher ARPUs will help telecom companies recover all their investments that they had to make in network infrastructure, including the recent rollout of 5G services. Now, interestingly, the government is being forced to help the smaller telecom players now so that they don't die. MTNL, which is another struggling player in the telecom sector, was about to default on bond interest payments just a few weeks ago. The government was just forced to pay this because of a guarantee. The government also stepped in to save BSNL last year. They approved a big rescue package worth more than rupees 80,000 crores to boost BSNL's 4G and 5G capabilities. See, last week I had spoken about how India wants to now be friends with China again. Here's a clip from that episode to give you a quick recap. See, India and China have had a rocky relationship since their border clash in 2020, but it looks like things are improving now. India still wants China to fix the border issue, but it also needs Chinese technology and investments to boost its industries. In fact, despite all the push for Make in India, it is still a little hard for India to manufacture everything all by themselves. Whether we accept it or not, we will still have to rely on China for certain things. Yesterday, Piyush Goyal, who's India's Commerce and Industry Minister, poured some cold water on this by saying that there is no plan to support Chinese investments despite what the economic survey suggested. Now, even though Chinese investments are very tiny in India, which is about 0.37% of our total FDI since 2000, our trade with China is huge. China is our biggest trading partner with trade worth more than 9,70,000 crores in just the last 1 year. We sell them iron ore, cotton, spices and veggies and buy a lot of electronics and machinery from them. The political tensions continue to remain high, but there are some selective areas where things seem to be getting better. There is also a growing recognition in the government that they cannot ban everything from China. Whether we like it or not, we need to work with China in some capacity. For instance, Indian solar companies like Tata Power Solar, Renew Photovoltaic, and Avada Electronics need Chinese experts to help them scale up their operations and meet our renewable energy goals. They are asking for visas for Chinese engineers and technicians who are crucial for their projects. Tata Power, for example, is investing 3,000 crore rupees in a new solar manufacturing plant in Tamil Nadu, and they need these experts to get it done for them. Without their help, projects could be delayed by quite a bit. Interestingly, the economic survey suggested that partnerships between Indian and Chinese companies could be a good idea in fact. These joint ventures or JVs would then let Chinese firms get around US restrictions by making goods in India and then exporting them to US. This would help them take advantage of India's better relationship with the West. But setting up these partnerships is not without problems. Making stuff in India is more expensive than making stuff in China. We also don't have the necessary technical skills, the infrastructure, and the extended ecosystem. The very fact that we have visa and import restrictions also does not help. To make these joint ventures work better, India needs to lower tariffs, improve the production linked incentive scheme or PLI scheme, and make it easier for businesses to operate. By doing this, we can make partnerships more attractive and also boost our manufacturing capabilities. So even though there is tension on the political front, economic needs are forcing cooperation between these two countries. Let's talk about how the world is slowly getting rid of coal and what it really means for the larger economy. See, in 2023, the world hit a very weird milestone. On one hand, we generated a record amount of electricity globally from coal, while on the other hand, we were able to reduce the share of coal in the world's power mix from 35.7% to 35.4%. Now, I know this reduction might seem a little small in terms of absolute numbers, but trust me, it's actually not. This reduction means that the world is now increasingly taking cognizance of climate change and is shifting away from coal to other renewable sources. In this story today, this shift from coal is exactly what I want to discuss. But before we get into it, let me tell you two of the many reasons why the world is even looking to move away from coal in the first place. See, coal produces the most amount of carbon dioxide per unit of energy as compared to other fossil fuels. Now, as you would have imagined, this is super harsh on the environment. In 2021, coal fired power plants were responsible for more than 20% of global greenhouse gas emissions. And if we have to stop a total collapse of our planet and possibly humanity as well, we really need to get rid of coal based power, and that is not really optional for us. The good news, however, is that the world is making progress. In developed countries, the decline in coal usage has been very sharp. In just 1 year, the US saw coal generation fall by 19%, and the European Union saw it drop by as much as 25%. Now, this is largely due to the rise of renewable sources like wind and solar, and also increase in energy efficiency and other technological improvements. But if you take a look at developing countries, the coal story is very different from that of developed countries today. China, which is the world's biggest coal consumer, increased its coal-fired generation by 5.9% in 2023. India, Vietnam, and Mexico also saw significant increases in this regard. Now, this was mainly due to horrendous heat waves and uneven monsoons across the world, which again are a result of climate change. These intense heat waves affected hydropower generation, which is a key part of the energy mix of the world. So, countries like China and India had to substitute the loss of electricity generated from hydropower with power generated from dirty coal. But here is an interesting counterfactual. Under a regular scenario, clean energy addition in 2023 would have reduced fossil generation. However, the shortfall in hydropower led to an increase in coal generation, which eventually led to a 1% increase in global power sector emissions. 95% of the coal generation rise in 2023 was in four countries that were severely affected by droughts: China, India, Vietnam, and Mexico. But what is interesting here is that even though China consumes the most amount of coal in the world, it is also the world leader when it comes to renewable energy deployment in everything from electric vehicles to solar energy. Closer to home, India has also set some very ambitious targets for clean energy growth in the coming few years, and we are kind of trying to follow China's example. Now, the main point of discussion here is not whether the countries like India and China can transition away from coal. It is more to do with how quickly this can be done without compromising or hampering the country's development goals. A transition like this is a huge deal. To begin with, we are talking about getting rid of a source that makes up 1/3 of the global energy mix. But apart from that, there are also massive human and economic costs associated with it. For one, most countries can't even transition away from coal right now because even if they wanted to, they can't afford anything else as an alternative. But hypothetically, even if you did move away from coal, solar and wind can't be the primary source of energy because you cannot depend on it. You really need something that can also fill the gap and be clean at the same time. The only source right now that fulfills both these criteria is nuclear energy, which again is super expensive. It also has a bad reputation because of Chernobyl and Fukushima. But as I said earlier, perhaps the biggest challenge here is financing. Poor and developing countries can't really afford this, and they don't have access to affordable financing even if they intend to go green. But that said, there are numerous benefits of moving away from coal. As a matter of fact, air pollution kills 1 out of 10 people in the world, and coal based power plants are a leading source of air pollution across the world. Moving away from coal means that we can prevent millions of people from dying and being incapacitated every single year. A healthy population naturally translates to an increased economic productivity. So let's hope we can all get our act together and stop killing ourselves and our planet. Well, that's all the news I have for you today. I hope you found value in this. See you tomorrow. Take care and goodbye.